All right, Tom, we got 2 minutes before our official start, but interesting that you are saying that for those folks who are with us here. I see about 13 of you have signed in. You get a little bit of a pre-log here from Tom and I, just kind of kibitzing a little bit about markets and what we're seeing at the moment and where we are. So, Tom, you were talking about a little bit more juice in the tank, possibly for the run between now and the end of the year. Do you still think we have a recession coming?
Yeah, I mean, and that's, I keep wanting to say yes, and it keeps saying no. I mean, everyone's predicted it, and usually when everyone predicts something, this has been the most predicted recession we've ever had, right? And yet it hasn't happened. So the question is that, just continues to confound people. I mean, they keep saying it's going to impinge on earnings. They keep saying that, once these interest rates bite and consumers stop spending, but it's just not happening. So the question is, like, once the Fed stops and you felt all of this 5+% in the economy and it just doesn't go anywhere, are we just at a structurally different place now where those same people that left during the pandemic just aren't going back to work? And they never will. And it doesn't matter what the economy is like. So are we where we are? And then once investors and consumers and everyone else that's involved in the market and the economy just stops and says, okay, I'm dealing with this 5% burden. It's only going to get better from here. I don't know how we get to a recession if the downside of this thing is an improvement of where we are, right? Because the whole point of the interest rates is supposed to slow the economy, right? And that's supposed to lead people to getting laid off. Well, if that's not happening because the job market is not cooperating, what are they going to do? Raise it to 10% and destroy the economy? They're not going to do that. And I think pretty much there's broad agreement that they're not going to raise it any further at this point, besides this next month. So I hate that term, soft landing. And at first I thought they were just circling and didn't know where the airport was. Right now it just seems like it's going to be a landing, and it might be a little bumpy. And I think, you can't look 6 months, a year out and predict what's going to happen then. But in this near term, this is uncanny, amazing market action that I think, we could probably go another 5% from here before, something else, some other cloud shows up on the horizon. But I don't think it's going to be the recession that everyone is saying or they expected. I just think it's just going to be kind of this like slow period. Then the Fed will start lowering rates maybe or normalize, and then we'll just take off again from there. That's kind of what it feels like right now.
All right. So glad you guys could join us. Just Tom and I kibitzing a little bit about where we see the markets. It certainly is very, very fluid. It's changing on an ongoing basis. And new data is coming in on a week-by-week basis. And certainly the positions that we believed in the beginning of the year has changed a lot since where we are at the moment. So welcome to our State of the Market. The purpose of our time here together is to get some great ideas and concepts from our Chief Investment Officer, Tom Siomades. I will always love to kind of bring you guys up to speed, and then we have a question and answer session after the fact. As we start our time here together, if you would please type in the chat box any questions that you have as we go through the presentation. When we're done, then during the presentation at the end, I will read those out loud, and then Tom and I then would bring forth some answers for you. We want to keep our compliance department happy, so here's all our disclosures for you. We're all licensed and insured and bonded to have this discussion, and so what we've been talking a little bit about before our official start is just, where are the markets? What is inflation doing? So we got a brand new hot inflation report that came out that it looks very promising. We're still looking at interest rates, what the Fed's going to do about interest rates. Do we going to have a recession? Is it going to be a soft landing? Is it going to be a hard recession? How does everything look like? And these days it's hard to have a discussion with your cell phone around because it seems like they're listening and AI is exploding and driving the tech markets up in a huge way. So with all that in context, Tom, why don't you share some ideas here? I've introduced you, and so everybody probably has met you. A lot of people have met you in person. We always enjoy you coming to Orlando. And but for those who do not know, this is Tom Siomades. He's Chief Investment Officer at AE Wealth Management. And Tom, why don't you take it from here? I can use your slides. You could just say, hey, hit the button, and I'll be happy to forward it for you.
Yeah, I can advance it from here too, so
right.
That'll work. I was actually still reading the disclosures, man, and you went past that. Hey, thanks everybody. Thanks for joining. Thanks for including me in the discussion. I love coming down and seeing Hilgard, but I will be honest, like July in Orlando, not my favorite time of year, but it's hot everywhere. I mean, it's obscenely hot here in Kansas. It's like it's going to be like the heat index is like 112 today, so ridiculously hot. Maybe that's a good segue into this equity market. So let's talk about really quickly about what we saw in the first half of the year and kind of how we ended. So last year, no surprises, was a miserable year. Okay, it was an ugly year, and it was just inflation was sky high. The Fed told us they were going to raise 50 basis points. They raised 5%. So nothing seemed to go well last year. Everything just seemed to be wrong all the time, 24/7. So, with that as a backdrop, right, we entered the year and we were really just, everyone was like kind of still a little bit in shock. And, their portfolios were struggling. It was definitely sort of, a little bit of a wake-up call. But a lot of times what ends up happening is, when that alarm clock rings, not all of us jump out of bed right at once, right? Some of us kind of hit the snooze. And I think that's kind of what happened with people in the markets, is they got to the point of where we're in this kind of like wait and see, let's see what happens. And a lot of that kind of was okay in the first few months of the year. But then we started, after we hit some inter-year, I guess, year-to-date lows, around the March timeframe, we started marching upward, and that was a very narrow rise from the standpoint of it was led mostly by technology, and as Hilgard mentioned earlier, it was a lot of this hubbub and flux around AI, and if we're looking at sort of the broad indices, yeah, I mean they were up. Right. If you're looking at the S&P in the first 6 months, you're looking at the Dow, sure, they were up. But at the end of the day, it was very narrow. Right. So that started to change in May. And I know these numbers are more, obviously they're higher today, because these are through June 30th. But we were pretty good through the end of June, the end of the second quarter. We're somewhere up around 12% on the S&P. I mean, the S&P here is like, this one was saying we were at 44, all fours. That's pretty cool. But I don't even know how you say it, hexagonal fours or whatever it is, Hilgard. So it was like we're up over 4,500. So it's continued to climb, and this has been one of those rallies where if you're not invested for the long term and you don't have a discipline plan and rebalance and as need be and get your exposure, there's a lot of people that were sitting on the sidelines on their hands and kind of missed this. And now I think what's happened is since the end of since the beginning of June, the end of May, people have started piling in, and that's sort of fueled a lot of what we're seeing going into this into 4th of July, and obviously this week with sort of the relief that we saw from inflation. Again, it's been more broad. Does it have room to go? Sure, it does. But we're also getting to the point where things are getting a little bit disconnected from the reality on the ground. It's, I think, there's some euphoria creeping into markets right now. International, better than last year. Actually, it's been a surprise, to be honest with you. But a lot of people tend to ignore it because of all the, Europe tends to have very dysfunctional economies. And also the war in Ukraine sort of threw a lot of shade on what's going on in Europe. But international has actually, done a lot better this year than expected. And I guess through the first half of the year, it had largely outperformed U.S. domestic markets. I don't know if that'll maintain, but it's still I guess the point is it still bodes well for the argument of you need to be diversified. You need to have a well thought out plan and stick with it through ups and downs, because you never know where sources of return are going to come from. Second quarter, interestingly enough, we got out of bear territory, and we saw lows in October of 2020, and we were, the definition was we were up 20% over out of those lows. So we didn't get back what we lost last year. Obviously, if you think back to what the all-time high in the S&P was around 4,800, and that was when we ended and basically started when we ended 21 and started 2022. We were right around 4,800. We still have a ways to go to catch up to that, but at least we got out of bear territory, which was, an achievement in and of itself. Inflation actually has dropped to 3% as of the reading this week. That's the top line number, CPI. So what's important for people to understand is that CPI was over 9% this time last year. It's down to 3%. The Fed doesn't necessarily react to the CPI because it looks at something else called core CPI, which excludes energy and food. I've had problems with that all the time because I think energy and food are very important items, and you shouldn't just discount them. The price of a bathing suit at Nordstrom's shouldn't be more important than your food and energy, but somehow some of that basket of goods that they use is different. But their level has also dropped to, I believe, 4.8, closer to 2%, but not close enough to where you can say we're guaranteed them stopping. But I'll get into the Fed in a second. But it's been good news. So producer prices, which were over 10%, which is the prices that people that make the stuff that we buy pay, was only up 2.6% year over year when it was up over 10%. And obviously that gets passed on to consumer costs, which again are down from 9 to 3%, which is clearly moving in the right direction. A lot of that, I think, has to do with the fact that we're not seeing $5 a gallon gas, and that could be a very, very volatile component. But for now, lower energy costs are being passed on into everything that we're using right now. So good news on inflation. The jobs, which is one of the things that I think the Fed was looking to try to cut back, have remained strong. And Hilgard and I were talking about this before the meeting started, was maybe we're in a different world now where a lot of the people that just decided to check out and stay home and drop out of the workforce are just not coming back. And so, despite the fact that pressure is being put on companies to increase, their borrowing costs are increases, it's getting more expensive for them to conduct business. What happens when, you need somebody and there just isn't 10 people lining up for every job? There's, 10 jobs for every 5 people. Well, there's what's known as wage inflation. Is you got to go out and you got to, same as you would bid on a house and you get into a bidding war, people get into bidding wage wars to get the employees they need. And then once they get them, they saw how painful and how hard it was to get that employee to come on board and what a difficult search it was. There's also a propensity, even though things may not be going as well as you want them to go, to let that person go, because you're thinking in the back of your mind, well, hell, if the markets and my business turns around, I'm going to need to hire this person back. So am I better off just kind of taking it in the chin for now and paying a little bit more and not laying that person off? So that component that the Fed wanted to really, really, use to destroy demand, which is basically what kills inflation, is when people quit buying stuff, people have to lower prices, right, in order for them to continue to sell it, right? So if that hasn't happened via jobs, that's been sort of the conundrum of the Fed, is they were saying, well, we'll just increase the rate of unemployment, and because of that, people will stop buying stuff. I think what's happened is, people didn't come back into the market, so that didn't lower wages, right? One. Two is, the other thing is, I think people have just changed the way they spend money. Now, I don't know if you guys have been to the airport lately, traveled anywhere, restaurants, everything's packed. I mean, it's just wall-to-wall people. they're just not buying stuff. They're spending their money on services, and that's contributed to a lot of these companies doing well. I mean, I don't know if people saw Delta earnings were explosive the other day. I mean, it's crazy. So anyway, the market is slowing down, but it's not slowing down to the point of where people are getting laid off, nor that we are in a recession. 1.3% growth in Q2. I'm sorry, Q1, and we're expecting Q2 at the end of this month, and that's supposed to, I think, be about in line with what Q1 was. I mean, it's awful, it's anemic, but it's not recession. So, we, as folks know, the definition of that is 2 consecutive negative growth quarters, and 1.3, I would argue, is not growth. It's just kind of barely treading water, but we're not underwater. So, I think the Fed's in a place now where they need to have some serious discussions about where they go next with respect to interest rates. So speaking of that, the Fed funds rate, as I mentioned, the Fed last year told us they were going to raise 0.5%. They're up to 5% now, which is a tenfold increase, very, very rapid increase, has slowed down the economy, has made some impact on inflation. But again, I don't know how much of that is inflation or fuel costs coupled with that, or their interest rate increases. Now, what's interesting is last year, folks remember we were having a pretty crappy first half of the year. And then the Fed went to Jackson Hole. And that's when Powell smacked down any talk whatsoever of any kind of rate cut in the back half of 2022. And that's when the market rolled over, gave up we were having a nice little rally up until August of last year. And then we just fell off a cliff because he just blew up all hopes of any kind of rate cut. Now, what's interesting is, Jackson Hole's coming up again, and they're going to have a meeting here in a couple of weeks, and they're going to raise their rate by 0.25%. It's pretty much baked in. The market's expecting it. But what's interesting is the market has not been expecting just one. They've been thinking that we're going to raise rates at this next meeting, and then somewhere in the next 3 meetings, there's a potential for another 25. So 0.5% between now and year end. Given all the things that we're seeing right now, the slowdown in the economy, jobs, remain stubbornly good, but the lowering in inflation, there's a real good chance that this time around Powell may say we're actually done at Jackson Hole if the numbers continue to be the way they are. So with that sort of a positioning place, it's an interesting place to be in markets right now, because if the market's expecting 2 more rate increases, we're going to get one. Just so don't be surprised you get one. But now it's like I'm looking at the Fed funds futures, and they're saying that there's actually a 60% chance that we may cut once by the end of the year. So whatever they put on the books these next 2 weeks might be gone in December. And I don't think the market's factored that in at all. They're factoring in 2, and I think they may be, by the time things are said and done by the end of the year, there may be 1 and then 1 that gets wiped out. So couple of things that just to be mindful of where we were in the second quarter. I don't know if folks were familiar with what was going on with like Signature Bank and New Republic, and a lot of that was that was just bad management of assets on the part of those banks. They actually were foolish enough to believe the Fed when the Fed said we're only going to raise 0.5%. Well, they went out and they bought long-term treasuries that were paying 2.5%. Well, when the Fed decided to change its tune, guess what happened? Their 2.5% bonds now weren't worth anywhere near the amount of money that was worth, that a 5% bond would be. And so, they were put under pressure when they went to sell them, because they were also in very narrow industries like the tech industry. And they, when people came for their deposits, they couldn't make them whole. So that a lot of those that Signature Bank and SVB and all that kind of stuff, scared, I think, the Fed to some extent. And maybe that's what led to the most recent pause. But that was a highlight of the second quarter. And actually it started at the end. It started in March of Q1. And that sort of hung out with the markets, as sort of a weight or an anchor around the market's necks in March and April. And then we started taking off again with all of the with all of the AI hype that we saw. The other thing that was there, and I don't know whether we have AI on the list here, Hilgard, but the debt ceiling debate, that was a big downer. Okay, that whole, no, I'm not going to negotiate. Yes, you are. Then, we're going to include this and that and the other. And here's where I am with debt ceilings. Look, I think if you have debt and you need to pay for it, you should pay for it. But I also don't think that includes that just because you agreed to pay for something that is clearly silly, like forgiving student loans and other nonsense. No, that doesn't get included as an obligation. That needs to be talked about. So I think funding the military, funding Social Security, Medicare, the functions of government, yeah, that's important. That stuff needs to happen. But when you start piling on ridiculous stuff like that, we're going to reform welfare in this bill. No, you're not. You're not going to reform it. You're going to fund government. But the problem is that scared the heck out of the markets. As usual, the government and all the various parties in there could not agree on anything, and they finally ended up funding it. They got some concessions, but I think there's a lot of silly stuff that gets packed into these things, and there's just not a place for it. It should be done during the regular budget negotiation. Whether you're going to fund 80,000 IRS agents should not be included as a given that's going to, well, we agreed to that. No, you agreed to that. There were a lot of people that were vocally against it. Don't just say just because you put it on paper, it needs to be funded. So there was that kind of stuff that kind of clouded things, which is not was not conductive to the market getting the warm and fuzzies. I mentioned the Fed interest rate hikes. I think that was one of the things that happened before was that the regional bank problems that we saw were really concerning to the Fed. They were like having kind of like an oh gosh moment at that point where they figured out that, maybe we've gone too hard, too fast. And that's one. I mean, they had already broken the real estate market. And I don't know, Hilgard, you were saying you were looking at homes and things like that. And it's like, look, when interest rates went up to 7% on a mortgage, that kind of had a very chilling effect on the real estate market. I mean, people didn't want to leave their homes because prices were inflated. And then they also didn't want to lose their 3 or 2.5 or 3 or 3.5% mortgage to go into something that was basically the same as what they had, but they're going to be paying 7%. So those are, that was sort of a similar kind of, movement that occurred with these regional banks that the Fed all of a sudden said, oh my gosh, maybe this is something that we need to back off on a little bit. And I think that kind of led to the pause to see what's going on. So, we're in a market that's at an inflection point at this point. I think, the good news in my view, Hilgard, is we're at an inflection point, but it's an inflection point in a good direction, right? It's not like we're at a point where like, man, what else can happen that's bad? I think we had a lot of things that we just talked about that was bad last year, right? Or even the first half. You had the debt ceiling, you had the banks failing, you had, slowdown in GDP, a lot of stuff was going on. And I don't see the same amount of stuff in the second half of the year. So is the coast clear? I don't know. I mean, when is it ever clear, right? There's always something that's going to come down the pike. I mean, barring any kind of extracurricular, black swan event kind of thing, I think there's just less hurdles in the second half. Now, does that mean we're going to put on another 15% in the second half of the year in the equity markets? Probably not, but I can see another 5, maybe between 5 and 10 as we end out the year, especially as if the Fed stops. If the Fed announces at Jackson Hole that we're done, and then the market's just going to start thinking more and more that, if they're not going to raise rates, what are they going to do? They're going to probably lower rates. And as we see economic softness, they're possibly going to start tweaking with lowering rates. The other thing to be mindful of, the longer we go into the year, the closer we get to next year's elections, right? And I would hate to be an incumbent person looking to get reelected, and the economy is going down the toilet. because people get angry. People, when they are angry, they don't vote for the person who's in charge. So there's enough social problems out there to get people angry. You don't want to add a recession to it, right? So there's going to be an immense amount of pressure on the Fed. And I know everyone, I know the first thing Jerome Powell always talks about when he stands up there is like how independent the Fed is. I don't buy any of that, okay? If folks remember, you could have just walked by, not even sat in or signed up for an Econ 101 class, just walked by and heard 3 sentences that you would have realized that when the government said inflation was transitory, that was a bunch of hooey, okay? The fact that Powell, as learned as he is, and the people at the Fed, as smart as they are, bought into that commentary, last year that inflation was transitory, tells me that Powell, what he was trying to do was he was trying not to upset the people that were going to basically rehire him. Because what happened he kept on saying inflation was transitory, blah, 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 right? He got confirmed in February of 2022. And in March of 2022, they started raising rates. What all of a sudden happened between the time when he was confirmed and he was saying it was transitory and a month later? Did he just, wake up all of a sudden and, have a come to Jesus moment? No, it was like he got his job, he was secure, and then he decided to do the right thing. But if he were truly independent, he would have been saying we needed to raise rates in advance of that, in advance of getting to 9% inflation. But that's why I think, when, despite the fact that what they may say the Fed is independent, I think the closer we get to elections, you're going to have an immense amount of pressure from the administration and incumbents ratcheting down on the Fed to just, if anything, not raise rates, and if anything, try to lower rates. So I think that's also going to be a good environment for equities. So that's at this point, I'm sitting here and I'm thinking, what do you do if you sat out and you missed out? To me, it's like, listen, there's never a bad time to apply your plan, right? And I think at the end of the day, don't look at it as you missed out on some numbers here, some numbers there. How effective are you implementing your plan right now? And I think that's what's important to have folks like Hilgard and his team on your side is you need to sit down with them and say, listen, you know what? Whatever's happened. It's water under the bridge. It's like, are you on track to meet whatever your goals are and your plans are? And then if you need to slowly and methodically work your way back into the market, dollar cost averaging is always effective. Diversification, doesn't cost you anything. I mean, those are, it's discipline. And I think that's one of the biggest things that people have a lack of is discipline, right? We get too high, we get too low, we get emotional. And at the end of the day, we miss out. And I think if you focus on being, longer term goals oriented and not necessarily the fact that, well, I got out and the market went up 10%. Well, you know what? You could sit here and wait for it to come back 10%, but you're going to miss the other 10 on the way up. So, that's always a possibility. So I will stop babbling.
Thank you, Tom.
And I'll be happy to hang around if people want to, ask questions or make comments. I'm happy to.
Yeah, probably the first question I'm going to ask, and then I've got a few questions here from folks who have been chatting up, and then I'll read over to you. But I think the biggest thing is are you saying it's risk on at this point in time? We might not have a recession next year, or are we saying that, hey, the market is running, there's nothing very clear at this point in time that precludes us from continuous growth? But what's the thinking and the thought to whether or not we will have a recession or a pullback next year?
Yeah, I think it's in the interim, in the next month or two, it's risk on, but it's also should be risk on with an eye to we're going to have some volatility, right? Because I mean, the next thing people will start talking about is, to your point, recessionary fears. Is it going to happen? Is it not going to happen? What are earnings going to look like? Is the Fed done? All of these things are going to continue to keep popping up. But in the meantime, the Fed doesn't do anything. Unemployment doesn't go up. Spending continues to occur. company earnings aren't really decimated, the market keeps marching on, right? And so to me, it's like I would be very careful. I wouldn't be overly aggressive. Like, if you're a 50-50 investor, I would be 52, right? Not 72. But at the same time, I also think there's opportunity here for us to move up. Now, will we get a recession? I mean, they've been, like I said earlier, they've been predicting this thing for 2 years now. I don't think we're going to get one in the next 3 to 6 months, but then you know how it works, right? When it happens, they never tell you that we are in a recession until a year goes by, and they say, oh, according to our data, we had a recession, in August of 2023. But I don't think things are that bad right now that you should, pull into your shell. And again, a recession doesn't necessarily mean it's going to be bad for investors. Typically the market is looking out 6 months in advance. And think about this. I mean, if the market is looking out 6 months in advance and we're having the kind of 6 months or the kind of action we're seeing right now, right? How could you expect a recession in January if we're, year-to-date highs at this point? So I can see it being sort of like one of these things where it's just a period of softness versus, people lining up at the unemployment office and massive layoffs. That's how I would characterize it. And if it's a recession where there isn't losses of jobs, that kind of bolsters consumer spending, and that bolsters companies' performance, right? So that's really, I think the biggest thing I would watch for is if we're going to have a recession, is I'd see if that unemployment number starts moving. If it doesn't move, we can have soft GDP. We can even have, like we were talking earlier, it's 1.3 in the first quarter, probably about 1.5 in the second quarter. And things are the way they are. You think it's really going to be bad if we go to like minus 0.03? People will still continue and go about their lives. So I think I wouldn't be overly aggressive, but I wouldn't be underweight equities, in the next 3 to 6 months. And at the same time, I also don't think, just when we think the recession is going to be bad, it never turns out the way people expect it to be.
Okay, excellent. So Tom, I got a few questions here from some folks. Let's see here. We're going to start at David is asking the question, could you comment on the effect of maybe more boomers deciding to retire during the pandemic, which has affected the labor market more than expected? So do you think that, one, boomers did that, and two, how's that affecting the labor markets?
I can't speak with certainty, but I would imagine if you were close to retirement and you saw the kind of nonsense that went on during the pandemic, I can't imagine that wouldn't have made your mind up for you. I think the biggest challenge with boomers retiring is all of the I guess intellectual capital and experience that we have. The productivity of the people coming in behind us is not up to snuff, right? Because they just haven't had time in the saddle for that. That said, we're in this sort of what's that? I always get those words confused. It's just a perpetual trend. We're in this retirement trend, right? What do they call it? They call it secular. Yeah, that's the word. We're in this sort of trend where, there's just like we have World War II vets dying at a record pace, and there won't be any. It's the same thing with boomers retiring, right? This is going to go on for the next, decade or so, and there'll never be the amount of people to replace them. So that's why I think, there's that component of where people are retiring and are leaving really good jobs, and there's no one to replace them. But there is a component where there's just a bunch of people that figured out a way to stay home and not want to go back to work. So that's the conundrum, right? You have experience and a certain mindset going out, and then you have another mindset that doesn't want to come back in and do the work and fill in. So we're going to continue to have this runoff of boomers retiring. That's just a fact of life. I mean, when you consider just the age bracket from whatever it was, 46 to 64, the sooner those 46ers and on get to 70, they're gonna drop off. There's just no one to replace them, and that's the scary part. I mean, and you also, you think about it, Hilgard, when we were talking about travel earlier, the mandated retirement of pilots. Who's going to replace that guy who's got 40 years of flying at 65, right? They just don't have them, and there's not as many people coming out of the military that flew. So that's kind of one function of the boomers sort of leaving. But I don't know that it was the pandemic per se versus that it was more of a natural sort of attrition, but it's accelerating.
Sure. Next question I got here is a crypto question. The question is would you comment on the issue of the Biden administration and the implementation of cryptocurrency and how it might affect our retirement savings?
Okay, so first off, I'll go on record. I'm not a fan of the crypto. I'm just not a fan. And all the stuff that they promote, you have to remember one simple thing about crypto is that the government can shut it down anytime it wants. They did that in China, and be mindful of this. Crypto is what? It's a competition to your national currency. What person in their right mind would want to have competition to whatever they're doing that they own 100%, right? So why would the government be any different? Why do they want crypto? They don't want crypto. They want to have their own digital dollar or whatever else. They want to control this. So my argument would simply be is like, if you want to invest in it to talk about it at a barbecue, and it may not be a very popular stance for some people. They're really, it's like with people in precious metals and things like that. They're really, really adamant about it. And I'm not here to talk you out of it. I'm just saying, if it were me, I would put no more than 2 or 3% of my net worth in something like that at most, right? And what I would also do is, maybe just buy it as a speculative investment, just something that I can get that keeps me occupied if I'm interested in investing. I don't believe, there may be, I think there's value in the blockchain stuff. I don't believe any government in its right mind would want to promote cryptocurrency. And I think this administration, as any administration that comes along, will not want to promote it. So, sorry if that's not the answer people want to hear, but I'm trying to be as honest as I can.
Thanks, Tom. Next question I got here has to do with the mergers and acquisition. Have you seen any uptick in M&A work or M&A activity, and how that affects the markets, specific as biotech, energy, other sectors?
Yeah, it's been muted. Usually, when you start having an uptick in IPO activity, I mean, it's usually, market is doing really great. It's really a good time. I think maybe now we're turning the corner. I think, one of the things that hurts tech for the most part is higher interest rates, although that didn't seem to stop those big movers that we saw when the market was really narrow. So I think we should start seeing more and more of it. But I think, interest rates need to be a little bit more favorable for M&A and for IPO activity.
Okay, so that's another question I got on that is, here's one of our clients here is working for a tech IPO or tech company that had a scheduled IPO in 2022. It was sidelined based upon the overall markets, right? So he's asking about the conditions of when he thinks his company would be able to IPO. And your immediate answer was interest rates for mergers and acquisitions, but interest rates obviously is important, when people borrow money to be able to buy other companies. But what about IPOs?
Yeah, I mean, it has to, is the market willing and looking for that, is it welcoming of it, right? And right now, I don't know that there's the immense amount of love for tech companies in general. Because think about it, if we're in an environment where We just lost money last year. Now we're in an environment where things are getting better, but I think people also want to see like an immediate, return on their investment too. So if you think about, the IPO part of it, especially if it's a tech one, it's like, when are you going to make my money back for me? So, I think it's a challenging environment. I don't really see a whole lot of them. But at the end of the day, I think, if the market becomes more and more favorable to that, then, then obviously it's going to impact pricing. But then, when people are buying these things, they're also, like I said earlier, they're also looking to borrow money in order to buy these things too. Not everyone's just sitting around on a pile of cash, and that's where the interest rates matter.
Okay. And then this is way out, but this is 2024. I say way out because in our language, anything beyond 6 months, 9 months, a year, it's it gets very difficult to even predict. But it is an election year next year, and this is a tough question. It's like, hey, what do you think? One, what do you think the S&P will do 2024, and how much do you think the elections will influence that?
There's all kinds of stuff out on the internet about what happens with stock prices during every year of a presidential administration.
Sure.
There's all that's out there. I think it in some respects it has this election as always is going to be contentious, as most recent elections have been. I think it's a question of who is going to, policy-wise, like what kind of policies we're going to follow, right? So this administration that we've currently have has been a complete 180 from the prior one. There's a lot of propensity for central planning. There's a lot of propensity to try to regulate. It's if that wins out, then that's not good, right? At the end of the day, we live in a country that was founded on with a bunch of cranky people who are unhappy with wherever the hell they came from. So now they come to America and they want to do what they want. They didn't come here because they liked the way their government was treating them wherever they were. So that's put a damper on the engine of ingenuity in this country, right? So then if you have a government that's behaving like, like some European government telling you how much, what kind of gas stove you can use, or if you can use, you got to drive an electric car, and all that kind of stuff just rankles people. And that's bad for business, right? I mean, you look at the auto industry, for example. Nobody wants to buy an EV. They're too expensive. They're beginning to back up. But then the government's coming in and telling Ford, no. You need to keep making these things because it's important. Makes no sense. But anyway, that said, if you could persist in having the sort of type of regime that we have right now, you're going to get more of that. And if you were to maybe get an alternative person or people or administration that maybe, reawakens our energy industry, maybe gets away from some of this green stuff, less regulations, right? I think all of those things are additive to. So net, I think the market always wants it. The market to me is like a cork. You can only hold it down for so long. It's going to keep wanting to come up. If you look at the charts, and I know, Hilgard, everyone says, well, I haven't lived 130 years and I can't look at the stock market from 1900 to 2023. But if you look at the direction. It's constantly going up and to the right, right? So if that's the case, and the market doesn't want to be held down, then the propensity of the market will always be to go up. It's just a question of what's that angle like. If you have an administration that's pro-business, lower regulation, energy independent, you're probably going to have a higher trajectory to that rise versus somebody who's trying to control everything and tax everything. And, that's...
Sure. Makes sense.
Yep.
Makes sense. Last question for you is, and we got about a minute or two, then I'm going to transition. But hey, is this a good time to still continue to buy fixed income?
It's fixed income suffered, as rates have gone up, and I don't think that you're at a place right now where you're going to see rates go much higher. So if you can buy something that's shorter term, that's, paying 5%, 4%, that's probably as good a rate as you're going to get. So from a yield standpoint, I'd say lock it in for a little while if that's your thing. I think what's going to happen is the fixed income that's out there now is, as rates start to come down, it's going to appreciate. So, you're going to get less yield, but, obviously if you own something that pays 5% and the going rate is 3%, your principal is going to go up on that piece. So
sure. It's probably it's more conservative buy. It's not a bad time probably for various conservative folks who want an income or yield from their investments at this point in time. And the markets are raging. The stock market is raging for sure. And compared to that, it's probably not as great as the stock market short term, but longer term it's not a bad play if you want to live on the yield and still experience appreciation of the value because interest is going down, right?
Yeah, just be mindful of the fact that, if you buy something and hold something, there's always the potential for reinvestment risk. So when the term of that bond, when it comes due and whatever whoever issued it wants it back, you're not going to be able to reinvest it at the same rate that you had it. But the other thing to think about is if you're interested in an annuity or have an annuity, have the conversation, because the cap rates are a lot better. The terms are a lot better with higher interest rates. So if you've got an annuity that that isn't maybe paying as much because you bought it 5 or 10 years ago, you're going to be pleasantly surprised at what you can, reinvest in now. And that you could lock that in. That's not going to go anywhere.
It's a good point. Very good point. We've seen a huge increase in cap rates in equity index annuities this year. Absolutely, Tom. And it's been a great opportunity for people to utilize that as another source of what we call pulling systematic distributions from a guaranteed environment to avoid the erosion of the capital. Well, Tom, thank you so much. I really, really appreciate your time today. Thank you, Tom, again for your participation and, as always, your help to our team. And we really enjoyed having all of you join us today. So have a great weekend. And thanks again, Tom, and look forward to seeing you soon.
Thanks, everybody. Have a great weekend.
Thank you.
Thanks.